All right. Guys, good evening. Anyways, let me greet the whole world. Good morning, good afternoon, good evening, wherever you are in the world. Welcome to Do Prime, the official sponsors of Manchester United. Presentation material that says the psychology of trading. Presenter Dr. Muller, your main man. I'm here. So today, we are going to look into the psychology of trading. And that is the most important part of trading. The most important part of trading. In my academy, I'll tell you, trading is a game of chess or a game of puzzle. When you win it upstairs, you're going to win it in the real market. Upstairs, I mean, if you win in your mind, you win. If you lose in your mind, you have already lost. So do you want to win or you want to lose? That's the psychology, the mindsets of trading. So today we are going to talk about the mindset of trading. All right? We're going to look at how we're going to trade it. Then in our next presentation, coming Wednesday, we're going to look at how to make money, all right, without money. Very, very important. We're going to make money without money. Some people will be asking how. Yes. If you are interested, please invite all your friends that want to make side hustle or they're eager to make money. Let's invite all of them here. We're all going to look at it. All right. So first of all, we're going to start the psychology of trading. So we're first of all going to look at the first things. The first things. As a trader, you have chosen the path of trading. Okay, you have chosen the path of trading. There are certain things you have to put together. What is the first one? Trading involves more than just analyzing charts. You open the chart, you click buy, you draw trend line, you find candlestick patterns and all of that. No. All right. And then executing trades. No. Trading goes way beyond that. It goes into details. That is how people thinks. Okay. The psychology, understanding the psychology factors that influence decision making is crucial for developing a profitable and sustainable trading strategy. So if you want to make money in trading, then you have to look at these things. They are very, very important. You have to look at them. Okay? Very, very, very. They are key. Right? So you have to look at these things. What's the first thing that we have to look at? Emotion and decision making. Emotions and decision making. A lot of you, your main problem in trading is very simple. Emotions. Emotions. Your main problem is emotions. The fear of losing money. The greed of making more money. This is your problem. Your emotions is your main problem. Nothing more, nothing less. And to be a successful trader, you have to deal with your emotions. You have to deal with them. Effective trading requires managing emotions that can cloud judgment. Emotions like fear, greed, and then overconfidence often lead to impulse decisions that undermine long-term success. Understanding how emotions impact decision making is crucial for developing a disciplined trading approach. Why is my material in double check? All right. So for you to trade, you have to first of all work on your emotions. I tell most of my students, friends, I trade like a robot, and they know. When I'm making money, I'm not excited. When I'm losing money, I'm not excited or angry. I'm neutral all the time. And that's how a trader should actually be like. It's very, very important. All right. You don't care what is actually happening. My boss will say, bull, bears, we don't care. All right. That's his slogan. Bulls, bears, we don't care. He doesn't care whether market goes bullish or market goes bearish. He doesn't care. Bull, bear, we don't care. Right? So, yeah, somebody is saying revenge trading. Yes, you lose $10. Yay, I have to get my money back. Then before you see, you have lost $50. Yes. The psychology of trading is very, very important. Very, very. I would say that is one thing you always have to guide your psychology. I say guide, sorry, guard. You understand? You have to guard your psychology very, very well so that you don't just fall prey to the market. Very simple. Today, I think we're having FOMC and then they are thinking of rate cuts. Some people are thinking of which lot size they should use, not based on risk management, emotions. They will make plenty money today, tonight. All right. Okay. Acknowledge emotional base. Recognize how fear, overconfidence, and other emotions can lead to irrational choices. I don't know if you have all experienced this. Sometimes you will just be taking trades in the middle of the night. When you know that there's no liquidity in the market, you are picking trades. And you'll be trading aggressively in the middle of the night. It's like that. It's like that sometimes. What exactly do you want to achieve within that night? Trading is a systematic plan. You plan and you follow the plan. You play according to the plan. Remove emotions out of the equation. Zero emotions. And when you do that, you are good. All right. Separate emotion from analysis. Maintain objectivity by basing decision on data, not guts, that is feelings or emotions. My instinct is telling me that Charlie, this thing you go buy. Then you start buying. My instinct is telling me that NFP will sell. Yeah, some of you have instincts and you trade with the instincts. Trading is not about instincts. It's about a strategy, a plan. So you have to develop the plan, the strategy that you are going to use. Make the strategy very simple. Follow it religiously. Follow the strategy. That's how it works. If you don't do that, you are not a trader. You are just a gambler. So I says, develop a trading plan, establish clear, unemotional rules to guide your decision making and prevent emotion or emotional impulse. All right. So if you want to trade, that's exactly what you want to do. Okay. Then what's the next move? remove emotions out of the equation. Remove all emotions, all, not one, all emotions. Okay? Once you do that, it's going to help you. Very, very good. It's going to help you. All right? It's going to help you. That's basically it. So if you want to trade, make money, set rules. Okay, what are the rules? Let's assume I'm going to trade 3 patterns. What are the 3 patterns? I'm going to trade head and shoulder pattern. I'm going to trade double tops. And then I'm going to trade triple tops. Oh, this one is wrong. Triple. Something like this. I'm going to trade this. And these are the only things you are going to trade. The first one, you set your rules. When I see engulfing candle or rejection here, and price have rejected 50 Fibonacci level, this is my sell. Or stochastic also crossing at 80, this is my sell. Or RSI at 80, this is my sell. So you have your rules set, and that's it. You are done. Did you get it? Very simple rules. So immediately you see this thing, oh, price is just moving, and then all of a sudden you find out that you have your head and shoulder forming. It is coming up like this. You pick your Fibonacci retracement tool, you measure, and then you have drawn your zone 50 and 61.8 like this, and you are waiting. Price gets there, did a rejection, nice one. Continuation, set. What is the next rule? Check if your stochastic or your RSI is crossing above 80. You check stochastic or RSI is crossing above 80. Bingo! Your trade is set. You enter. What is your risk to reward? I risk 2%. Sorry, risk to reward ratio 1:3. All right, 1:3. That is your risk to reward ratio. So you risk 1%. Let's say 2%. So you are targeting 2 times 3, 6. So you are targeting 6 here. If you reach 2 here, you target 6. And then bingo, your trade will go successfully as planned. This shows that you have planned your trades and you are following the rules religiously. All right? But some of you, you have no plan. Trust me, you have no plan when it comes to trading. You have no plan. A lot of you. All right? And it's not a problem. We know it's not a problem. But you want to succeed in trading, it will be very, very hard. Like I said, trading is a game of chess. That's how I see it. I see it to be a game of chess, right? Or a game of puzzle. It's a puzzle. So you find the pieces. So if you want to trade it very well, then you also have to have a plan. And that is where you would be good at whatever you are doing. If not, you will be just a gambler. Just a gambler. And I don't think any of you want to be gamblers. I don't think so. All right? I don't think so at all. So sit down, do observations. Okay? You do observation of the charts. let's assume, let me give you an example. Let me use Euro USD. So let me give you an example. I did this analysis for someone in our last meeting. So let me give you an example. Let's say this is your plan. Let me delete this, my indicator. And then we're going to look for a Stoch. All right, a Stoch. So let me see if that is what I'm looking for. Yeah. This one, this stochastics. All right. So let's assume that my plan is to trade this pattern called zigzag. This is my plan, all right, is to trade zigzags. The zigzag should be rejecting 100 and 1236 Fibonacci levels somewhere here. It can go as far as here, but let's say somewhere here. I've standardized everything. So this is my zone that I'll be trading. This with A, this with B, and this with C. Perfect. Like this. Nice stuff. This is what I want to trade. Okay. So that's the pattern right there. That's the pattern. 1, 2, 3. So when the pattern is completed, what is next? I have to buy. All right. So I'll be buying right from this zone. But before I'll buy, I'll have to do certain things too as well. First of all, I'll have to see an engulfing candle or a rejection candle. Okay? Engulfing candle, a rejection candle in this box. Right? Good. So price came and then we got into the box specifically. Then we have this huge candle. You can be buying from somewhere here. That is fine. You can be buying from somewhere here. That's fine. All right. Good. Now you enter your trade. Let's find the risk to reward ratios. So you are risking 1%. So this 1%, and then we want to make a target of how many? 3, right? 3 somewhere here. 1, 1 to 3. So this 3, 2. Bingo. So this 3. A risk to reward of 1:3. And you can see it clearly. We hit that target. That's it right there. Even if you make it 1:5, a 1:4, you will still hit the target. But this is the safest. You reach 1 to 3, right? 1:3. You see, with this, you have a plan. All right. And then the second rule is that you probably want to see the stochastic crossing below 20. And then that was the cross. So this is telling me that, okay, I can buy here. Because one, structure is 1 point. Candlesticks, candle is 1 point. Fibonacci, Fib, 1 point. Indicator, another 1 point. In total, we have scored, what? 4 points, 4/4. If these are rule, this is 4/4. This is bingo. All right. If these are rule, this is 4/4. And look at how the trade went. So you have a plan. and you are trading according to the plan. A lot of you do not have a plan. You don't. Even if you have, they are not clear. You adjust it anytime and anywhere. All right, which is not the best. All right, let's go. Maintaining discipline. Remember, it is not all the time that you're going to make profit with your strategy. It's not all the time. Some of you, you want to win each and every single trade in this world. It's impossible. And I will tell you, there is no holy grail anywhere. That a strategy proven to win all trades. Some people will say, oh, Doc, I need your tool. They get a tool and then they'll be like, I think it's called all the accurate trades in the world. It doesn't call all the accurate trades in the world. You're going to lose some of it. But 95% of the time, it is right. That's it. You don't need a strategy that can be 100% to make profit. No. Some people are even using a strategy which is 10% accurate, just 10% accurate, and they are making profit. Discipline. Developing and sticking to a disciplined trading approach is essential for a long-term success. Resisting the urge to make emotional, impulsive decisions can be challenging, but consistent, that is the word, consistent methodical execution of your strategy is key. So your method or your strategy that you are using, you don't change it. Follow the rules religiously. Follow it. All right? And that is one problem about traders. They can't follow their rules. Once they have a trade hitting the stop loss, the strategy is not good. They have to change it. Once a single trade hits stop loss, let me show you something so that you laugh. I'll show you something so that you laugh. All right. So this is my trading strategy, my personal trading strategy. I've used this strategy for a very long time, and I'm still using it. Somebody got this same strategy, place a trade right here, and didn't make profits, and is complaining like the strategy does not work. Now, we are going to look at it. So, the strategy started with this kind of trade. And that's it. The trades keep going. That's clear. And they keep going, and you can see it keep going. This area that you are seeing is actually in another time frame, which is the 5 minutes. All right. Oh, where is it? Hold on 1 second. Okay. Yeah. Okay, so this is the part, or that is not it. Let's see which one it fits. Okay, it fits the other one. Good. So let's clear it up. So this part that you are seeing actually is another time frame. Another time frame. And then we're going to check it out. All right. So where is it? That's it right here. See how accurate this thing is calling all the trades. It's calling all the trades like a boss. All the trades. But because you lost one single trade, one single trade. Where is that trade? You lost a trade here. It means that the strategy is no good. Does it mean that way? Does it mean that the strategy is no good? No, that is not it. The strategy is really good because if you count 100 trades, 95 of the trades will be profits, and 3 of them will be loss. Okay? If you count 100 trades, 95, yes, 95 of them, all right, will be profitable. The rest, which is the 5%, will be lost. And that is not once. We can also watch this strategy on all time scale. Watch it. So let's watch the same strategy in all time scale. That is the daily we are talking about. Strategy call is trade for you. You make profit. You call that, you make profit. You call that, you make profit. You call that, and you're making profit. You call this, you make profit. You call this, and you were in a little loss. Call this, you made profit. Call even this, and you're making profit. Is this a bad strategy? Now we will shift from this same time frame to another. All right. I'm just doing this to explain that one trade, just one, that's my strategy. It's my personal strategy. It's called a Molar Mass. It's my personal strategy. All right. Just one trade alone does not determine or tells that the strategy is not good. Just look at this. Just look at this. Look at that. Look at that. Just look at this, that. Will you say you've lost just a single trade, so the strategy is not good? Yes, some of you, your minds, that is how it is programmed. It means that you have to win all the trades in the world. There's no strategy that can win all the trade in the world. If that is your main problem, stop trading because there's none. All the strategies in the world, you're going to lose some and make some. But what is the percentage? What is the percentage? Just watch this. What is the percentage? That's the most important part. Yes, it's purchasable, but a little bit costly. So you can chat me, and then we'll talk about that. Or you can join my page, and then you see everything in there. All right, guys, this is very simple, very simple, very. And you can see from all the time frame, I started downgrading the time frames, and I keep downgrading. An indicator is still doing the same thing, calling all the trades like a boss, just calling them. All right. So if you place this trade and you lose it, it means that the strategy is not good. This trade was called already in a higher time frame. This trade. So if you lose this one, there's no problem. The strategy is very good and very potent. I've been using it for the past 4 years. Right? And it works like magic. It really works. Especially with the 1 minute. I love the 1 minute. I love it. If you place this trade, you would have made some profits. You place this trade, you made profit. You place this trade, you lose. You place this trade, you made profit. Place, made profit. Place, made profit. Which one did you join? Which WhatsApp did you join? All right. So all that I'm trying to put across is that all that I'm trying to put across is very simple. Okay? Very, very simple. Simple as ABCD. Very, very simple. Simple as ABCD. What is it all about? It's not about the strategy or a winning strategy that wins every single trade, but rather it's you. Set simple rules, obey the rules diligently, be disciplined on the rules, be firm on the rules. Don't bend, cut corners. No. Managing emotions. How do you manage emotions? So we are going to learn how to manage emotions. First, recognize triggers. Identify the specific market conditions, that is events or situations, that tends to elicit strong emotional response from you. In recent times, I have not been giving you any market forecast. Why? Because I told you fundamentally, gold is going to the moon. Technically, gold is going to the sea. So because of this reason, I don't want to be giving problems. I'm not giving signals. And I'm not trading myself. Very simple. But some of you, you are still trading till today. You are trading. Yes, it's your personal decisions. Okay. So if you are in there, you can chat me. All right. You can chat me. All right. So practice mindfulness. I keep saying that not trading is part of trading. One of the best traders in the world in trading history is W.D. Gann. W.D. Gann actually at a point was not trading. And then his secretary asked him why. And Gann replied, very simple, very, very simple. The simplest answer. The simplest answer. He just told the guy, trading is based on price and time. That's all. So if price aligns with time, he trades and make a lot of money. W.D. Gann traded $100 to $100,000 in 3 weeks. And he didn't place up to 10 trades. He didn't place up to 10 trades, 10 single trades. That should tell you the accuracy. Not trading is part of trading. Newbies have the problem, this problem. When they don't trade one single day, they will be itching. Their body itches. They will be shaking, which is very, very bad. You don't have to trade all the time. You have to wait. Let the market come to you, then you trade. Anytime the market comes into your trading strategy, you make profit. If you like, go check your journals. I don't think if some of you still have journals to write in. But if you have journals, you would know what I'm talking about. All right? So you follow the rules and you make money. Simple. Let the market come to you. Don't go to the market. When you go to the market will do you anyhow. Let the market come to you. All right, let's go again. Implement strategies. So it's very, very important you pen down whatever happens when you are trading. The trades that goes into profits, the trades that goes into profits will be the ones that when you go back and then you check what is the alignment of X and Y, you will see that it makes a lot of sense. But if you don't do that, you don't write anything. You just buy, you just sell, you just close, you just do anything anyhow. You are treating forex trading like a gambling. No, treat it as a business. Keep records. I place a trade at this point or at that point, and I make this profit, and that's keep doing that. You're going to find the reasons. But if you don't do that, you won't find a reason. When you lose, you just lose. You just lost. And when you are winning, hey, everybody will get to know that you are winning. Then when you start losing, forex is a scam. That story I've heard it so many times. Forex is a scam. And it's funny. So write down. When you keep writing down, you will see that some particular moves works for you better than others. My students knows me very well. I don't like triangles because they don't work for me. Some of them, it really works for them. I'm the one who trains them. But it really works for them. But it doesn't work for me. So I don't trade it. Find what works for you and what doesn't work for you. Then you can see the progress. All right. Seek support. Join WhatsApp trading groups. Find people that actually makes a lot of sense in these groups, not the ones that are just posting results. No, they don't show you setup. The next thing you see, they posted results. They don't show setup. The next thing you see, they show results. All right? Follow the one that gives you setups and then the results. Setup and results. Now seek help, possible mentorship, support, guidance from these people. They can help you. Myself, I'm here. I can help you. Nikki is also there. He can help you. Right? Now we are going to do a comparison. We are going to do a comparison. We are going to check two types of traders. One, Alex, and the other one, Michael. All right. And then we're going to look at these traders, how they've been able to overcome their emotions and how far they have moved. So first of all, let's meet Alex, a seasoned forex trader who has consistently generated positive returns through disciplined risk management and then systematic trading approach. Alex's case study provides valuable insights into building a profitable forex strategy. So Alex sat down and then he said, okay, this is what I'm going to do. He planned every single thing, and he's using it and he's making money. Now let's come to Jane. Overcoming emotional hurdles. Jane case study demonstrates how managing emotions and developing mental resilience are crucial for forex traders. She shares her journey of learning to control impulses and maintaining composure during volatile market conditions. So when market is actually with Jane says, okay, emotions is the main problem. When market is actually unstable, she gets calm, like nothing is happening. She has put her risk management, everything in place. Bulls or bears, she don't care. Guys, I think you are getting the concept here. What are you getting out of these three traders? In fact, two traders. Now let's come to Michael. In case study, we explore how Michael, a successful forex trader, has adapted his trading strategy to changing market dynamics. His ability to identify and capitalize on new opportunities has been the key to his long-term success. What are we studying here? All these people are traders, but they can do one thing better than the other. All right? Michael is very good at trend changes. When trend changes, Michael will be able to spot the reversals of all the trends. What about Jane? Jane is able to be calm in time of news whatsoever. She's very calm. She's very relaxed. She doesn't panic. And she delivers. And what about Alex? Alex is very disciplined and consistent. Disciplined to all the rules and very, very consistent. So all of them has a nice traits or nice traits. That is good for all of them. As a trader, you cannot be everything. You can be one. You can do good at one. So when you identify yours, use it to your advantage. Last time I was teaching a group of people, and then I was telling them that all of them cannot be like me. And they said, no, they will all be like me. I said, no, it's not possible. They cannot. It's not possible. They can't be like me. And they start to argue. And I said, okay. I started giving them the reasons why they can't be like me. They can be like themselves, but not me. So I asked them a simple question. When do you close your trade? Say, oh, I don't close. I keep holding when everything has pointed that the trade is reversing or whatsoever before they close. Everybody give their answers. And I told them, with me, I close my trade when I see money. So if I want $1,000 and I see $1,000 on the trading desk, I pick it. That's all. I'm done. I don't care about structures. I don't care about indicators. I don't care about any other things. I care about money. And they were very surprised. I said, okay, now you see, you can't be like me. What is your risk tolerance? What's your risk tolerance? Some of them started mentioning, oh, I can go 50, I can go 10, I can go this, can go that. Everybody's own is very different from mine. That means that the way I can tolerate risk, you can't tolerate it. Can you be like me? No. So find what is good in you and then sharpen it up and use it to your advantage. You can't be like any other trader in the world. You can be like you. You can't be like any other trader in the world. You can't be like you. All right? So guys, these are some of the things. These are some of the things. And it's very, very important. Very, very, very important that you keep to these things. Successful risk management. This is an area also where a lot of traders don't even know what it is. Risk management. They don't know. It's not like they know, they don't know. Some people know, but they can't apply it because they don't know the basics of trading. How to calculate lot sizes, how to calculate stop losses, how to do this, how to do that. They have no idea. All right. So it's like that sometimes. It's like that. All right, let's go. So we have to start defining the risk. Define your risk tolerance. Define your risk tolerance. It's very, very important. Risk tolerance. Understand your potential or your personal risk appetite and set clear boundaries for the maximum risk you are willing to take on each trade. So what is your maximum risk? $50, $20, $10, $100, $5,000. What is your maximum risk? So if that is your maximum risk, I have deposited $100,000 into my Doe Prime account and I have started trading. Okay. I would not allow my maximum risk to be $10,000 or $5,000. Once you get to $5,000, you know you are done. You won't trade again. What is your maximum risk? Some of you don't have a maximum risk. You are trading till you lose everything. You don't know your risk. You have none. So when you lose everything, then that is your risk. You are done. All right? So what is your maximum risk? Risk very well. Set boundaries. Okay, I'm willing to lose 50% of my capital. When I lose that, I'm okay. I'm fine. That's fine. All right? So you set your boundaries. Diversify your positions. This does not affect me because I only trade one asset. If you also trade one asset, that's good for you. I only trade one asset, and all of you know I only trade gold. But it's good sometimes you trade other assets like Euro USD, or the USD card. So that once in a while, when things are not good, like in this period of this Iraq bombing, Russia bombing Ukraine, or Hamas, Israel attacking Hamas, and all of that, you probably would have had other positions that are not affected by the fundamentals. As the saying goes, don't put all your eggs in one basket. So spread your capital across multiple currencies, right? If you are specialized like me, that is fine. If you are not, spread it so that when you are losing, you don't lose all on all trades. And don't also trade correlated pairs. being it positive or negative, don't trade it. And then employ stop loss. Use a stop loss. A lot of traders don't use stop losses. With the notion that the brokers target their stop losses. Broker have no time. They don't even check your trade. They don't know what you are even doing. They have no time. Trust me. They have no time. Broker wish you can trade every single day and make profit. That's their wish for you. Because when you are trading and you are opening volumes or you are opening lot sizes, they would make money. They make commissions. So what would he gain if you lose your money? Nothing. He won't gain anything. Zero. What are the importance of risk management? One, it protects your capital. Two, manage volatility. Three, maintain consistency. And four, enhance profitability. Very, very good. Somebody is asking, how does risk management protect my capital? And the simple answer is this. The market woman selling stuff in the market knows when she would go for a break even. She knows when she will take a loss. When it comes to trading, there's no difference. It's the same thing. As a trader, you should know when you will take a loss, when you will break even. It's not always profit. This one thing about traders. When they start trading, everything they think about is profit. There is no business in the world that only thinks about profit. There's no business. Not at all. You think both profits, loss, and break even. That's the rule of every business. Profits, loss, or break even. So when you get profits, that is the expectation, that is the goal. When you get loss, is what we don't expect. When we get a break even, that is deliberate to protect your capital. All right, market volatility. The Forex market can be very, very volatile. Today alone, gold dropped about 400 to 500 pips. Gold alone. If you are at the wrong side of the market, it means that you are going to lose extremely heavy. And if you are on the right side of the market, it means that you are going to make good profits or decent profits. But what is going to protect you in this market is very simple. Risk management. All right, maintaining consistency. Maintaining consistency. How do you maintain consistency? That's the question somebody is asking. You always have to practice good money management and then stay true to your strategy that is being disciplined. Erase all emotions. Once you know that, okay, at worst, I'll lose $10. If it comes to worse, you know you are losing $10 out of your $1,000. You are good. You can sleep and wake up. But you don't know how much you are losing when it comes to worse. and you don't know how much you are making when it comes to West. Remember one thing about forex trading, which all of you have been seeing on the internet, Facebook, YouTube, wherever, especially Instagram. Somebody turn $100 to $100,000 in one day or one single trade. Then you believe it, enters into your head, and you do the same thing to your $100 account. You are going to lose it. It's not a curse. That's the truth. Ask yourself, how many times did this person try this thing and it was successful? Is it even real? You don't ask yourself these questions, do you? No, you don't. And this is what happens. Then when you see it, you'll be like, oh, I can also do the same thing. Then you open your account, you start loading the lot sizes. The next minute, you get it. If you don't get it, forget about it. As simple as ABCD. Some of you, whatever you see on the internet, you replicate the same things in your trading account. I saw one lady that traded options. She used $1 to, is it $34,000? Winning, I think, 18 successful trades. So I saw people were asking, how did you do it? How did you do it? This is crazy. This, that, this, that. I don't doubt that it's not possible. It's very, very possible. Winning 10 trades or 18 trades successfully. It's very, very possible. All right? Very, very possible. But ask yourself, how many times did she do it and was recording? How many times? For all you know, she has lost more than $1,000. Doing that for 1,000 times before one went through. And that is what she recorded for you to see. I'm not saying it's not possible. It's very, very possible. But my question is, how many times? All that you see on the internet, because they don't tell you when they started and when they are ending, don't jump into conclusions. Don't. Not at all. Because they didn't tell you when they started. I turned $1, all right, to $2,000 in almost 3 weeks. But when somebody sees it, will be like, oh, this is very simple. This is simple. Or I can tell you I can do it. Do you know how many times I tried? You don't know. You have no idea. All right? That's one problem. So for you to be a trader, you also have to watch all these things. It's very, very critical. Like I said, guard your psychology, guard your mind. Follow the plan, the strategy, follow it. Sticking to the plan. That's what we've got into. Sticking to the plan. As a trader, you always have to stick to the plan. Always. And that is what will make you the money. Always stick to the plan. First of all, clearly define your trading plan and strategy. The rules, clearly define them. No shortcuts. Secondly, be disciplined. Commit your time. follow the plan religiously. Then after some time, monitor your progress and then adjust. All right. Like I said, some of the trades probably are not good for you. So you don't do it. You don't take those trades. So you adjust. You keep adjusting. If you want to be very, very successful in trading, then stick to the plan. And if you don't have a plan, from today, go sit down, get a plan. Because once you get the plan and you stick to it, it will open, it will unlock the profits. All right. Once you get to it, it will unlock the profits. Very, very simple. We've gotten to this point that says identify entry and exit points. In every trading plan, you have to define the rules of entry and the rules of exit. All right. It's just simple. Rules of entry. When these rules are met, I'm going into the trade. When they are not, I'm not going. Let's get example. I want to trade this particular pattern called head and shoulder pattern. That's my strategy. All right. So I want to trade it. What's my rules? So we're going to define the rules and then we are going to use it. This is the plan. Sorry, this is the this is the way the pattern looks like. The pattern is like this. Right? Or the inverse. It looks like this. Good. Then we have the neckline. The necklines. Rule number one. Rule number one. When this pattern is identified, okay, I will look for a flat pattern or a zigzag here. That's my first rule. So I'll look for a structure like this at this point. Then I'll look for the strong level of support or strong level of resistance. Okay. Let me change the color for this one. So let me change the color to red. Aha. So I'm going to change for here to red. Perfect. Then it should reject the 50 and then the 618 Fibonacci retracement tool. So it should reject it. It should reject these levels. So 50, 50 and 61, this one. So it should reject these levels. All right. Then we have the strong level. We have the strong levels. Good. Everything is set. Nice one. Okay. Fibonacci again for here. Yeah. Fibonacci again for here. Let's push this one a little bit. Okay, good. Perfect. So there's a zone. My trigger zones. My trigger zones. So this is where I'm going to be buying, or this is where I'm going to be selling from. Then I should see stochastic in a buy market, sorry, in the sell market, stochastic crossing above 80. In a buy market, stochastic crossing below 20. And I'm good. I have no plan and I don't know how to go about it. Do you know how to trade? That's the first question. If you know how to trade, how long have you been trading? That's the second question. All right. So, first of all, we're going to look at this chart and then we would identify a pattern that looks like what we are looking for. And instantly, my eyes have spotted this. So my eyes have spotted this one. Oh, undo. Bingo. So this is the left shoulder, this is the right shoulder, and this is our neckline. This is our neckline. Perfect. We're going to mark the strong level of support. Perfect. In fact, it's even go all the way. So this is a strong level of support. You can see price have rejected the area. Oh, where's my, I can't find it. Okay. So you can see price have rejected this level, rejected it, rejected it, rejected it, and rejected it. So we've rejected this zone so many times. All right. Very simple support and resistance stuff. So what's our rule? Now we have seen it, that this is the pattern. This is the left shoulder, head, and then right shoulder. This should be our trigger point. And we said that we have to look for 50 and then 1.618. And that is the zone right there. Bingo. What a wow. Okay. So it looks exactly like that. Now we should get this pattern in there. And that is the pattern 1, 2, and 3. All right. That's the pattern right there. The pattern is inside there. Okay. What is the next thing? We said that stochastic should be crossing below 20. Stochastic should be crossing below 20. So we're going to get a stochastic to cross below 20. And bingo, it crosses there. All right. Everything is perfect. We should get a rejection candle or engulfing or any kind of rejection candles. And voila, we have a rejection, a Pinocchio bar or a pin bar. That's it right there. Right there. Okay. We have it right there. This is telling me that I should buy. Now, where should I target? What should be my take profit if I'm buying from here? If I'm buying from here, what should be my targets? Stop loss should be below the head. Okay, so these are targets. Sorry, these are risk. All right, we are risking this. Then what is our target? Now we have to know our target. What's the rules for the target? Very simple. Rules for the target. Finding head and shoulder, the rules is very, very simple. You measure from the head to the neckline. Very simple. And then you extrapolate it like this. All right, now this is your target level. Bingo. So what is the risk? You are risking 1:2. 1:3. So you can see you are risking 1 to 2.9. So 1:3 if we round it up. 1:3. That's the 10. And look at how beautiful it worked out. You have made your money. This is what we call a plan. All right? You have drawn or write out each and every single thing you're looking for. And everything is playing according to your plan. When that happens, there's no way down for you to win. So we have defined the entry rules, the exits. What time frame do I trade according to my plan? I don't trade a time frame. All right. I trade my plan. Okay. So you see, very simple. The rules we just set. These are just rules we just set right now. We just set these rules. And this trade has delivered exactly as planned. Are you guys following? Does it make sense? Does this one make sense? Okay. Done. Oh, this thing, let me buy. Then you just buy. Oh, it's coming. Okay, close. You close. Then you buy. You don't know exactly what you are doing. So I have given you two different simple trading plan today that you can use. Right? Let's go on. So you have to set your entry points or your entry plans and exit plans all the time. Mastering the act of identifying optimal entry and exit points is crucial for a successful trading. This session, okay. Let's go. So what are we going to look at? We're going to look at some of the technical analysis techniques. You are talking like you know me, but you don't know me. I just did 1 hour analysis. Does not mean I trade 1 hour. Ask everybody, I use 50 minutes. I even trade one minute time frame. So you talking whatever you are talking about, you have no clue. All right. I don't trade time frames. Okay, let's go. So let's look at some of the technical analysis techniques. Some of them. What are some of the technical analysis techniques? We are going to look at chart patterns. That is double tops, triple tops, head and shoulders, inverse head and shoulders, cup and handles, triangles, and then the entry and exit point. And I've done two of them already. Applying technical indicators as moving averages, that is moving averages, RSI, MACD, Bollinger Bands, to confirm trend directions and spot overbought and oversold. All right, very simple. I think I've introduced that already. And then I've also introduced the support and resistance. So let's move. Fundamentals. Fundamentals. So let's go to the fundamentals. Understanding or fundamental analysis approach. Some of you would approach the market fundamentally, and it's good to approach the market fundamentally, right? You have to understand the employment data. You have to understand the policies, GDPs, inflation, CPIs. You have to understand all these things, and then you would use that to make a long-term forecast of the market. All right. So you can approach the market technically, and you can also approach the market fundamentally. Somebody will say fundamentally. Right? All right. So let's go get how it looks like. I've shown you this over and over and over again. I've shown you over and over again this. So you can also have this approach to the market where you are going to look into the labor market, sales and production, employment, inflation, GDP, interest rates, and then you are going to do justice to all of these things to give you the forecast of the market. That is fundamentals. You are just looking at the data to trade. So after you have done all of these things, some people also use indicators. All right. So confirming entry exit signals with indicators. That is technical indicators, fundamental indicators, and then you find a confluence. When we talk about confluence, you are talking about putting all of them together. Oh, yes. Putting all of them together. You can trade technically, have your technical understanding of the market. That is using your indicators, stochastics, RSI, moving averages, all of these things, put all of them together. Price action, head and shoulder, what, put all of them, technicals. Then fundamentals, that is the economic data, the earnings, the GDP, the CPIs, put all of them also together. Let it give you a direction of the market. When these two guys, they meet, market go haywire. When they don't meet, don't follow what market is doing. Just sit back and relax. That's basically it. So when fundamentals aligns with technical, market move well, and you understand what market is doing. You understand it. But if the two of them does not align, there's no confluence, then trust me, just sleep. Don't do anything. I said not trading is part of trading. All right. Perfect. Let's go. Identifying chart patterns, and then good. Now let's come to one important part of trading, which is back testing. All right. Back testing, the importance of back testing. A lot of you, oh, this thing works, then that's it. You will not do anything again. You want to make money. Massa, like I keep telling you guys, trading is a business. All right. It's the biggest financial market in the whole world, 7.5 trillion US dollars. 7.5. The pharmaceutical company is in billions. All right. If you want to be a pharmacy, you want to produce chemicals, you want to be a doctor, you go to school, minimum 8 years, 9 years. That industry is in billions. It's not in trillions, it's in billions. The forex market is in trillions. But with that one, the next day, they teach you, oh, this bullish engulfing. This one is Angima. This one is Harami. This one is this. This one is Dragonfly. And then they finish teaching you. The next minute, I'm a pro trader. And I'm making money. I'm killing the market. You are not killing anything. The market is planning to kill you. All right? Oh, don't worry. Trading is all about the candlesticks. You see this Harami. You see this engulfing candle. Oh, it has engulfed. And that's it. Hi. If it was just engulfing candlesticks, then people would have been trillionaires. If it's just a Pinocchio bar, a pin bar rejection, any of the pin bar, whether hanging man, dragonfly, whatever. If it is only those things, trust me, people would have been trillionaires by now. You will not come and meet the forex market alive. He say, the sound I feel It's very simple. Very, very simple. You want to make money in the $1 trillion industry, and you think you can learn for 2 days, and you come and meet the big boys like George Soros, the man who broke the Bank of England. You come and meet his company and outsmart them. Are you smarter than them? Guys, think about it. If you want to be consistent and make money in this industry, the first thing you have to do is learn. The second is remove the L, that is you earn. You don't want to commit your time one bit into forex trading, to learning, but you want to make money. Oh, you are a joke. Stop trading. Stop. Go and find other profession and do it. Trading is really, really hard. Trust me. It's really hard. You can't just come into trading forex 2-3 days and you want to make millions of money. It is impossible. It will never happen. You have to learn the drill. You have to learn the drill. All right? And learning the drill, you follow through before you be initiated. It's initiation. Losing money your first time is part of our rituals. It's initiation process. Yes, I know all of you here have lost money. If you have been trading, you have lost money. Yes, it's part of the initiation. We are initiating you into the world of forex. So those times people came to me and they want to learn trading, I told them, hey, can you come around, come. Let's go to Volta Lake, or let's go to Accra Mall. Let's go here or let's go there. How much do you have on you? Bring like 5,000 Ghana cedis, or bring like 10,000 Ghana cedis. Then when we get to the mall, start spreading the money, throw it in the air. Let people pick it. When you finish, come back home and sleep. If you can sleep well, then you are ready to trade. Sometimes if I think of the money I have lost, I feel like crying. You have not lost any money, my brother. You have not lost any money. Some of us, if we talk our own, you just vanish. You have not lost any money. You don't talk. You have not lost any money. How much have you lost, my brother? How much? You just tell me. Because me, my own is plenty. But when the market started to pay me, it is paying me. That's how it works. How much have you lost? Henry, how much have you lost? I want to see it. I want to see it. Some of you, some people will be laughing right now when he writes his. So one thing is understanding the past performance. Backtesting is very, very good. Every strategy would show how powerful the strategy is. How powerful the strategy is will be shown, all right, over time. Okay, over time it will be shown clearly. Isaac said I've lost 1,500. Okay, that's nice. That's nice. I'm waiting for Henry's own. Henry, I'm waiting for you. Henry, I'm waiting for you. Henry, I'm waiting for Henry's own. All right. So you have to do a back test about 1,000. 1,000. You started just last year. You have lost 1,000. You see people are laughing. 1,000. Henry. You see they are laughing at you now. $1,000. $1,000 is my spread. All right. All right. That's just by the way. That's just by the way. All right, guys. So let's continue. You have to do a back test, do critical observation, formulate your hypothesis, treat Forex like a business, all right? Treat Forex like a business, all right? So you formulate your policy, your hypothesis. You start writing, oh, when I see this, I see that, I see that. Back test it. Go previously, come forward. There's a back test option, okay, that you can do all of that. Okay, let me go over the back test quickly. So each and every one of you have these back test tool, or everybody has it. Everybody has it. All right, it's a back test tool. Very, very simple. Let me get mine for you right away. So to back test, who is worrying us with AstroPay, AstroPay, AstroPay? Here is not the reef. Here is not the reef. Okay, so first of all, let's get a back test of any strategy. So let's say you want a strategy, you want to back test it very, very badly. Let's get one of these strategies. So I'm going to do one of these strategies, all right? So you say test, as simple as ABCD. And once you click on the test should pop up. All right, so the strategy you want to test will be at the top. If it is an indicator, you choose, okay? If it is whatever it is, you just choose it. So if it is an expert advisor, you choose, indicator, you choose, all right? Then where you want to test it, maybe you want to test it in currencies, commodities, you select them. Then the time frame you want to test it on, you select. Then when you want to start the back testing, all right? Let me say last month. And then that's it, I'm done. I'll click like this and the indicator would pop up. Okay, the back test would start like this. Once it starts, you will start seeing whatever your strategy is doing. So probably this one strategy, when we cross here, I will buy. And then when we cross downwards, so I'm waiting, market has crossed, then I will sell. All right, if that is your strategy, do you get it? So that's what. So this strategy is actually divergence. So it says divergence has appeared and that's it. All right, so that's back testing. So you can do a back test of all your strategies. Okay, you can do a back test to check how effective and powerful that strategy is. Okay. Then you have to identify the strengths and weaknesses of the strategy. And then the second thing is optimize the parameters. Probably one or two things are not correct. You optimize it, you change it. You keep tweaking and tweaking and tweaking till you get the best you want. Okay, that's how we work. So before I tell you my strategy is X or Y, I know what I have done. If you are doing technical fundamental analysis, then you have to do the same things. You have to go through the historical data. You collect all the data. With their website, there are so many of them. If you Google, you get to them. And then you start going through. Then you match it with the charts. All right. Then you have to optimize your trading strategies. Optimize it. Use CoralPay. Use CoralPay. CoralPay will help you withdraw. All right. Okay. So at this point, guys, we have come to the end of the class. Today, I've spent exactly 1 hour, 30 minutes, no more, no less. And I'm going to pause. If you have any questions, you can ask. All right. All right. So I have answered all your questions, and I think we are done. We'll meet again on Wednesday. Right? We'll meet again on Wednesday. Wednesday, we are going to learn how to make money without money. Marcos, Marcus, what's your question? I would say, at this point, I will say, thanks so much for coming. I would like to see you all again Wednesday. My name is Dr. Muller, and I will say bye for now, guys.